Hi guys, my name is Rushali. I hope you all are doing great. Today we are here to learn about the Negotiable Instruments Act. Okay, this is chapter 7 for CA Foundation students, and this is one chapter which has been newly added in the CA Foundation curriculum. So we are going to see what all things are there in this act, which is there in our curriculum, and we'll be learning it. Okay, so this is what we are going to study today, the Negotiable Instruments Act 1881. Negotiable instrument. Negotiation means that where we need to talk with the people, negotiate the price, where we need to bargain, where we need to settle down. That is called as negotiation. So, negotiable instrument is a signed document that guarantees the payment of a specific sum to a specified person, either in demand or at set of time. Like checks, right? Check is a negotiable instrument. When you give a check, when you issue a check to someone, you might have heard from your parents or your siblings or anyone else that give me a check of this amount. So when they give that check of that amount, particular amount, suppose 1 lakh rupees, that 1 lakh rupees is to be paid to the person whose name is written on the check. The person issuing the check is one party, and the person who is going to receive the amount is another party. Okay, we'll be seeing all these things, payer, payee, all these things we'll be seeing during the chapter. Let's just see what all things are covered in this chapter, what we need to learn. So we'll start with the chapter covers notes, bills, and checks, types, classification, and its characteristics. Then we'll be learning about modes of negotiation, how negotiation is done, what modes are used. Then we'll be seeing presentment of instruments, where these instruments are presented to the person or to the bank. Check is given in the bank. So we'll be seeing where these notes are presented, and rules of compensation, how the things are going to be compensated, how the money is going to be compensated, we'll be seeing over here. Okay, let's start with the introduction of the chapter. Let's see what they have given. Yeah, give me 1 second. Law relating to negotiable instrument is the law of the commercial world. In the commercial world, where we are exchanging the money, where we are exchanging the goods and services, we require negotiable instruments law, right? Which has been enacted to facilitate the activities in trade and commerce. What all activities in trade and commerce are required? For this, we'll be needing it. Trade and commerce constitutes of selling the goods, purchasing the goods, selling or purchasing of the services, right? Now, we need to make the provision for it, and these instruments of credit will be deemed be converted into money. Making provision for giving sanctity to the instruments of credit which could be deemed to be convertible into money and easily passable from one person to another. You can easily pass this document to one person to another. So suppose a bill of exchange is there or promissory notes is there, that can be easily passed from one person to another subject to some rules, right? In absence of such instruments, the trade and commerce activities were likely to be adversely affected, as it was not practicable for trading community to carry with the bulk of currency in force. There was lot of money involved, and there were lot many transactions involved. So people were concerned about how their money will flow, what is the security of their money. So that time, this negotiable instrument act was came into force. Okay, the source of Indian law relating to such instruments is admittedly the English common law. From the English common law, they have taken this source. Main objective is to legalize the system. There should be a legal manner how the money is going to flow, how the instruments are going to be issued, people are going to receive the money. So that is the main objective of this act, to legalize the system by which instruments contemplated by it could pass from hand to hand by negotiation like any other goods. Like you pass the goods and services. Suppose you want to buy a set of headphones, or you want to buy some cell phone. So that is a good that is going to be negotiated and sent further, right? When the cell phone is introduced, or when the cell phone is manufactured, it is sent to the retailer or the wholesaler. First, the cell phone is sent to the wholesaler. Then wholesaler sells it to the retailer. Retailers have the option of sending it offline or online. Retailers can do it by any of the medium. Retailers can do it through a website, or they can do it through their shops, or they can sell it to the direct customers also, right? So they always have an option to sell it. That is the one medium, how it is going hand to hand. Now, cell phone being only a good, like this cell phone is there. So this is a good that is being sent. Same way, negotiable instrument, checks, promissory notes, bill of exchange, these are also goods, kind of working like goods, which can be sent from one person to another, right? The law in India relating to negotiable instruments is contained in the Negotiable Instrument Act. Whatever law is given in India, it is given under the Negotiable Instruments Act 1881. It is an act to define and amend the law relating to promissory notes. As I told you, promissory notes, bill of exchange, and checks. So we have got a little idea of how many types of negotiable instruments are there. So majorly there are three: promissory notes, bill of exchange, and checks. Act applies to whole of India, but nothing herein contained affects the Reserve Bank of India Act 1934. It is applying to whole of India. Entire India is subject to the Negotiable Instruments Act 1881. But whatever provisions are there in the RBI Act 1934, they won't be affected by it. They do not get affected by the provisions of the Negotiable Instruments Act 1881, right? Section 21, which provides the bank to have the right to transact government in business. So they have given why it is not going to affect, because government has a separate entity. They have a separate act made, Reserve Bank of India Act 1934. So whatever provisions are there in RBI Act 1934, that will be prevailing. But nothing herein affects the RBI Act or affects any local usage relating to any instrument in Oriental language. If there is some other instrument which is not mentioned in this act and that is being used locally, so that is not going to be affected by this act. Okay. I hope we are clear with introduction, how Negotiable Instruments Act came into force, how the things are working, right? Let's go ahead. Let's see what they have given further, right? Provided that such usages may be excluded by any words in the body of instrument which indicate an intention that the legal relation of parties thereto shall be governed by this act, and it shall come into force on the first day of March 1882. So this act came into force on 1st March of 1882, and they have mentioned if the instrument is there, there should be indication that this is under the act. All the things provided in it should be taken into consideration, right? The parties have the legal relation and they have an intention to transact with each other, that is given, and this act came into force on 1st day of March 1882. Provisions of this act are also applicable to Hindus unless there is local usage of the contrary. Also applicable to hundis. Sorry, it is hundis. Hundis is a system which we'll be learning, right? So, if the hundi system is there, it is also applicable to these things. But unless there is some local usage, if they have some different law for hundis, that will be applied. That will be given a priority. Other native instruments like treasury bill, bearer debentures, railway receipts, delivery orders, bill of lading, etc., are also considered as negotiable instruments, either by mercantile custom or under any other enactments. What they have said now, treasury bills, your bearer debentures, all these things will also be considered as your negotiable instruments, either by the mercantile customs. By customs means the goods are sent out of India or goods are received into India, right? That comes under your customs. So treasury bills and the bearer documents, all these different documents also will be considered under negotiable instruments. And they have said that if there is no other enactment for them, they will be considered over here. Similar way as it was given earlier, that hundis will be considered if there is no other legal law. If there is different law for treasury bills, bearer debentures, railway receipts, delivery orders, bill of lading, etc., they will be considered under the different law. If there is no such law, it is considered under the Negotiable Instrument Act 1881. I hope we are clear. So we have more or less bills, bill of exchange, then we have notes, checks, and we also saw these things, that is your treasury bills, bearer debentures, railway receipts, delivery orders, bill of lading, etc. Right? So all these things are majorly considered over here in our examples of negotiable instrument, types of negotiable instrument. They have given about some recent developments. The act was amended several times, and the significant amendments were made in the Negotiable Instruments Act, Instruments Amendment and Miscellaneous Provisions Act 2002, 2015 and 2018. So we are going to read all the amended things over here. Okay, let's see what negotiable instruments is. As I told you, this is a signed document which shows that a sum of money is to be paid to a specified person. Okay, let's see what definition they have given. Negotiable instruments is an instrument. The word instrument means a document. Instrument means a document which is freely transferable. You can transfer it freely by customs of trade. In under trade, you can follow it. You can transfer it from one person to another by mere delivery or by endorsement and delivery. By mere delivery means you directly give it to them, or endorse it. You write it that this is endorsed to someone else. This is given on behalf of someone else, and delivery. Then you have to give them also. The property in such an instrument passed to a bona fide transferee for value. The property, whatever amount is going to be received. Property here means the specified sum of amount that is to be received. In such an instrument passed to a bona fide transferee. Bona fide person, person in good faith. Bona fide means good faith, under good faith. Transferee for value, that will be given for some value. If I have a check of 1 lakh rupees, I give it to Mr. A. Right? Mr. A has to pay amount to Mr. B. So what he'll do, he'll transfer that check, he'll endorse that check and give it to Mr. B. Right? So the check which I was going to pay him, the money which I was going to pay to Mr. A, that will be transferred to Mr. B. Right? See, we'll see over here. R was supposed to pay some amount, and R did not have, A also, R was going to pay some amount to A. I need to reduce proximity. See, R was going to pay to A had to pay to B. So what he does, whatever check was received from R, he'll transfer it to B. Now R will directly pay to B, right? So this is how the things work. The instrument is transferred to a bona fide transferee. Bona fide means a good faith transferee. We'll be learning all these terms over here. Just for the definition, I'm explaining you who's a bona fide transferee. Person who has received in good faith. There is no coercion, there is no physical abuse, or there is no gun pointing on them. All these things are not there. There is no disadvantage taken or any forces applied, fraudulent ways taken. Okay. Now, Act does not define the term negotiable instruments. Act is not defining the term negotiable instruments. Give me 1 second. Yes. So what they've said, the Act is not defining the term negotiable instruments. However, Section 13 of the Act provide only 3 kinds of negotiable instruments. As I told you earlier also, majorly there are 3 kinds of negotiable instruments. What are all these? Bill of exchange. Then we have your promissory notes. Then we have your checks over here, payable either to order or bearer. If order is given to someone, like if I give the order to pay to A, if R is giving order to A to pay the amount to B, don't pay me, R says, don't pay me, do not pay the amount to me, pay the amount directly to B. So this is by order. Or bearer, if I say that give it to the person who has the check. Now check is with C. I had a check received from A. R got a check from A. R received a check from A. Now I said, don't give it to me, give it to B. So this was by order. I had a check of 1 lakh rupees. R had a check of 1 lakh rupees. What R did is, R gave it directly to C. Now, what will happen on the date of payment? What A will say? A will go to R, ask her, do you want the money? Like, where is the check? Give me, I'll give you the money. Now, what R does is, R has already given check to C, right? R has already given check to C. Now, what A will do? A will have to give money to C because C is the bearer, who is the holder of the check. The person who holds the check is the bearer of the check. Okay, check or any other negotiable instrument. I hope this bearer and order is clear a little bit to you. Then we'll be discussing everything in detail. But wherever the words are coming, I'm trying to explain you clearly over there. Okay. Now, we saw that there are majorly three types as per section 13. Bill of exchange, promissory notes and checks. Payable either to order or bearer. I hope to order and bearer is a little clear. In detail, when we'll be seeing the negotiable instruments, you'll understand what is to order and bearer, right? It is to be noted that hundis, treasury bill, bearer documents, railway receipts, delivery orders, bill of lading, etc. are also considered as negotiable instruments either by mercantile custom or usage, either by normal customs, though whatever transactions every person follows, that is called as mercantile custom, or by usage, by the regular usage. If we follow this policy that bill of lading is to be acted as negotiable instrument, so it is going to act as negotiable instruments undoubtedly. Okay. A negotiable instrument is payable to order when it is expressed to be so payable. As I told you, R was to receive some amount from A. R directs A that give the money to B. Now, it is expressed to be so payable. It is expressed. I have given the expression. I have given the order that pay this amount to B. Don't pay R, pay to B. Right? When it is expressed to be payable to a specified person and does not contain words prohibiting its transfer, that is, it is transferable by endorsement and delivery. If I say that do not transfer this money to anyone else other than me, if I tell to A that A, you cannot transfer this money to any other person than me, then that is a restriction, that is prohibition on transfer. But what they have said over here, this is the opposite. When it is expressed to be payable to a specified person, paid to a specified person, and there is no words prohibiting, I'm not giving any condition. You can pay it to the person who is having the check, give it to them. Okay, that is what I have mentioned. So this is a negotiable instrument and it is payable by order. Payable by order. It is expressed to be payable. So if I say R, don't pay me the money. If I say to A, don't pay me the money, pay it to B. So he'll be paying to B. If I don't write on the document that it is to be paid only to me, there is no restriction, no prohibition given by me. So it is to be paid to the person who is having the bill, who is having the note or who is having the check, any type of negotiable instrument. I hope we are a little clear over here. By order means it is expressed to pay so, or which document the negotiable instrument is there. There is no restriction prohibiting the transfer. There is no words written that you can't transfer this. Okay. You might have heard from any of your parents or any of your elder siblings that the check contains a crossed check, right? These two cross lines are there on the check. Crossed check means that this is to be deposited in the account of that person only. If they write over here account payee, that means they are putting a restriction. We'll be seeing it further. Just for your information, I'm telling. So here, when there is no prohibition on transfer and when it is expressed to be payable to such person, then you say it is payable by order. Okay, I hope we are clear. We'll be seeing the next one. A negotiable instrument is payable when it is expressed to be so payable. Pay bearer. When they say that pay bearer, when it is expressed to be said so. When they say whosoever has this document, negotiable instrument, check, bill of exchange or promissory note will get the money. If R says, R gives a check to A, right? R gives a check to A. Now, who is going to pay the amount? R is going to pay, right? Now, A is going to pay to B. A wants to pay amount to B. What he does, he gives the check to B. Check is transferred. Now, A has already transferred the check to B. Now, what happens in the check system? I'll just give you a little information and insight about this. R has to give the money to A, but R has given a check. Now what R will do, on the date of payment, R will deposit in bank, right? Deposit in bank. You might have heard that checks are deposited in the bank. So R will give the money to the bank. He will deposit the cash in the bank, because whenever the due date is there, A will go and withdraw the money. He doesn't know who is going to take it. Now, what has happened? The check that was there is given to B. Now B goes to their bank. B goes to their bank and gives the check. B says that I want this money. What bank will do? Bank will see if in R's account this money is available. Bank has checked in R's account the money is available. Bank will give the money. Bank is going to give the money to B. Now bank has given the money to B. But who it was to be paid originally? To A. What A did? A gave it and said whosoever is having that check will get the money. If instead of A, he didn't give it to A. If instead of B, he didn't give it to B, let's just consider, and R gave the check to A. He said on the due date, you will make the payment. Suppose today we'll take the date as 15th of February, right? 15 Feb 2024, they'll have to pay the money, right? R will pay the money to A. On 15th of February, an unknown person, before A could give it, this check to the bank, he lost the check. Some random guy got it. And on the check, it was written bearer check to self. Now, what has happened? A has directly lost the check and it has gone to some X person. He's a thief. Let's just consider he's a thief. He got the check. That is a bearer check. Now, X will go to his bank. X is going to go to his bank and give the check. What bank will do? Bank will say, okay, this is a bearer check. Give me the check. I'll give you the amount. He got the amount. This is how bearer checks work. Now, the person where no name is mentioned, whosoever is holding that negotiable instrument is going to get the amount. So that is when the payment is done or the negotiable instrument is payable to a bearer. Okay, I hope bearer is clear. I give you 2-3 examples. I hope it is clear to you now. Now, when the only or last endorsement means signing of the instrument on the instrument is an endorsement in blank, that is the person who proposes it can demand payment. For example, a check made payable to a specified person and the check is endorsed by signing on the back of the check by that specified person. Now, what they have said, a check is given. A check made made payable to a specified person. Let's consider A. A was the specified person to whom it was payable to. Now, and that check is endorsed by signing on the back. What happens when you give a check, you want to endorse it, you sign it on the back of it and give it the check. Signing on the back of the check by that specified person. A has given this check to someone else. Let's suppose B. So it is also going to be paid to B. That is also payable to bearer. If A has specified that this check is endorsed to someone else, to B, so B is going to receive the payment. If B goes further and gives it to C, now B has endorsed it to be paid to C. Now C is going to get the amount. This is how the cycle will work, right? So whosoever is the person who is bearing that negotiable instrument, bearing that check, will get the money. Okay, last endorsement who has, person who is holding the check on the date of payment. As I told you, on 15th of February, the payment is to be done. On 15th of February, if the check is in the hands of C, R will have to make the payment to C. Got it? No one else will get the payment. The person holding the amount on the date of endorsement or on the last day of endorsement, last day of payment, that is the person who is going to get the money. I hope it is clear that who is bearer, when someone, there is no name mentioned or no specification given, then the person holding the bearer check, bearer document, negotiable instrument will get the money. Or when the only or last endorsement is done, if I only give the name, that only give it to B, so only B will get the money. If it is the last endorsement, B has sent it to C, so that is the last date. On 15th of February, C is having the negotiable instrument or check, so C is going to get the payment, right? Only or last endorsement, this is also comes under bearer. When payment is to be done or payable to bearer, one person who is having the negotiable instrument. I hope we are clear about negotiable instrument payable to order and payable to bearer. Okay, when these conditions are met, then we pay to order or we pay to bearer. Hope we are clear till here. Let's go ahead. Let's see what they have given. Now, essential characteristics, what all things are important in the negotiable instruments, right? What I said, it is necessarily in writing, compulsory that the negotiable instrument should be in writing. There is this compulsion that it should be. They've said that this negotiable instrument should be compulsorily in writing. It is necessarily in writing. It should be signed. We should be having the sign of the person who is giving the instrument. This instrument cannot be used or cannot be taken into consideration if it is not signed, right? So it is important that it is signed. Then it is freely transferable from one person to another. It should be freely transferable from one person to another. Holder's title is free from defects. As I told you that this checks should not be containing any defects. That means there shouldn't be any fraudulent way or any the murder or any theft kind of thing. This should be free from defects. There should not be any coercion or any defect in the document. Okay, now it can be transferred any number of time till its satisfaction. As I told you, A gave it to B gave it to C, and the things go on like this. Things goes on. A gave it to B gave it to C. So, and these things move on. Like they are going to continuously transfer it until its satisfaction. Satisfaction over here means that until the last person on the date of payment. As I gave you the example on 15th of February, whosoever is going to have that document will be getting the amount, will be getting the sum of money paid, right? Then, every negotiable instrument must contain an unconditional promise or order to pay money. The promise or order to pay must consist of money only. It is compulsory. Negotiable instruments cannot be given to any person if there is no money involved. For non-monetary transaction, there is no negotiable instrument. If money is involved, negotiable instruments can be generated. And there should be unconditional promise. There should not be any condition that pay me on this date only, pay me on that date only. These all things should not be there. Okay, these all points are not relevant. So it must be in writing. It should be signed, freely transferable from one person to another. Holder's title is free from defects, can be transferred any number of times till its satisfaction, and negotiable instrument must contain an unconditional promise or order to pay money. Promise or order to pay must consist of money only. So if this question is asked to you in examination, 4 or 5 points you should minimum remember. First 5 are very easy. This is the 6th point which I want you to learn because this is a very important point. Unconditional promise is there and it should involve money only. Okay. Sum payable, the time of payment, payee must be certain. There should not be uncertainty. There should be a specific date. You can't give random 2 months and 5 days. Like you can't give in 2 months. In 2 months, in how many days? What is the date of payment? Can be paid in future. What is the future? What is the date? It should be certain. How much amount is to be paid? The time of payment. What is the time of payment and who is to be paid? Like who is going to pay and to who, which person it is to be paid should be certain. Who is going to pay the amount, what amount is to be paid, at what time of payment will be there, how many days it is going to take. All these things should be certain, clearly mentioned. Instrument should be delivered. Mere drawing of instrument does not create a liability. The instrument should be delivered. Most important, it should be given to the person. If I am issuing, R is issuing a document to A, so A should have that document in his hands. It is compulsory that document is there in the hands of A. It is not that just I have created the document and kept it with me. It doesn't work. If I am drawing a check, if I am making an instrument, it should be sent to that person. If I draw a check, if I create a check, I have to send it to A compulsorily. Okay. I hope these essential characteristics of negotiable instruments are clear. This can be asked as a direct question to you. This can be asked for 2 to 4 marks, depending on how many you mention it and what they give the criteria for this. 8 points are there. If you excel in 8 of them, all these things, if you write clearly, I hope they'll ask you for 3 to 6 marks. Like if they give you for 3 marks also, you have to mention 6 points. If they give it to you for 4 marks, all the 8 points you have to mention very easily and very clearly. You can remember. Necessarily in writing, should be signed, freely transferable from one person to another, holder's title is free from defects, it can be transferred any number of times till its satisfaction. Every negotiable instrument must contain an unconditional promise. There can be no condition. An order is to pay money. Sum payable, time of payment, the payee must be certain. Instrument should be delivered. Mere drawing of instrument cannot create the liability. They have given you a little table over here for understanding what all are the characteristics. Okay. I hope this is clear. Now let's see all the types of negotiable instruments. First, they have given you a promissory note. That is a promise to be made. A promissory note, as per section 4 of the Negotiable Instruments Act 1881, promissory note is an instrument in writing, not being a bank note or currency note. This is not a bank note. This is not a currency note. You have to keep this in mind. There is not a currency note. This is not a money that we use, right? A promissory note is an instrument in writing containing an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of instrument. As we saw, to the order or certain person or the bearer of instrument, right? Now, let's see here what they have said. A promissory note is an instrument in writing. First condition satisfied in writing, not being a bank note or currency note, containing an unconditional undertaking. We saw that unconditional promises to be signed, again an essential characteristics, by the maker, the person who is creating it, to pay a certain sum of money. Sum of money is to be specified, should be certain. Only two. If I want only one person to receive it, if I want only A to receive it, or to the order of, if A gives the order to B, or a certain person, or only to C, order of a certain person or to the bearer of instrument. Suppose D is bearing the instrument, D is having the instrument. So it can be paid to D also, right? A promissory note is an instrument in writing containing an unconditional undertaking signed by the maker. Let's see how a promissory note is made, right? So this is for 10,000 rupees, which is made. It is made in Lucknow and it was made on April 10, 2022. Okay. 3 months after date, I promise to pay Sri Ramesh, payee. I promise to pay Sri Ramesh. Sri Ramesh is the one who is going to receive the money. This should be certain. 10,000 certain amount again, April 10, 3 months after date. Okay. Or to his order, or if he gives order to pay it to someone else. Ramesh gives the order to pay to Suresh. So that is to order. The sum of rupees 10,000 for value received. For the value received means, that means he has received some goods or he has received some services. For the value received, he is going to pay. These words are important for you. This is the basic format and this is the simplest format. We need to keep this in mind. Specimen of promissory note. It is very important for you to understand this pattern and how you have to draw it. Then after that is done, you put a stamp over here, sign it, and this was done by Ram. Okay, the person issuing this is Mr. Ram. They have mentioned. Okay. Now, this is again given to whom? Their details are going to come over here. To Sri Ramesh B. Green Park, Mumbai, maker. Okay, he is the maker of it. Got it? I hope these things are clear. 3 months after date, I promise to pay Sri Ramesh, payee, or to his order the sum of rupees 10,000 for the value received. So, Sri Ramesh is going to pay this amount. I promise to pay Sri Ramesh. This person is going to pay the amount to Sri Ramesh. Okay. Or his order, someone else. If Sri Ramesh says that go and give this money to this person, then we have to do it. right? This is made on the behalf of the person to whom we need to pay the amount. Now, we need to see what are the parties to promissory notes. Maker, the person who makes the promise to pay the money is called the maker. Sri Ramesh was the person who is going to pay the amount, so he is the maker over here. Okay. He is the debtor and must sign the document. He is the maker. He is the debtor who has to give the amount. I hope you have heard this word debtor, creditor in your accounts, right? Promise to pay is called the maker. He is the debtor and must sign the instrument. He must sign the instrument. Payee is the person to whom the amount on the note is payable. The person who is going to get the amount, 10,000 rupees is the payee. Okay. Customer. Customer is the drawer, maker, debtor, payer. Customer is the one who is going to pay the money. Suppose you buy something, you buy a phone. So you are the drawer, right? You are the maker, debtor, payer. You are going to pay the amount because some goods are purchased or services are taken. Suppose you buy a cell phone. So you have been supplied the goods or services. Now you issue a promissory note. The maker only issues the promissory note to the payee or the drawee, the supplier. If you buy the phone from Flipkart, so Flipkart is going to be your supplier. If you buy the phone from your local store, so that is going to be a supplier, right? Essential characteristics of a promissory note, it should be in writing as we saw. An oral promise to pay is not sufficient. What I've said, an oral promise will not work. There must be an expression promise to pay. They must express an promise to pay. They have to give a promise to pay. Mere acknowledgement of debt is insufficient. That they make a promise to pay. They must write it. They must express an opinion, express a promise that they are going to pay this amount. If you are buying the phone, you have to promise the seller that I am going to pay the amount. This is how it is done. Promise to pay should be definite and unconditional. It should be of a specified amount. It should be clear and definite. Unconditional. You can't put a condition that I'll pay you after 10 days or that I'll pay you if the rain does not stop in our city. This is not a condition you can put. Or if someone dies, then only I'll pay you. There is no such condition to be put. Okay. Therefore, instruments payable on performance or non-performance of a particular act or the happening or non-happening of the event are not promissory notes. As I told you that you can't say that if performance is done, if you give me 500 phones, then only like we don't give some unrealistic things. Like you don't say them, if you dance for me, if you perform a dance for me, then only I'll give you the amount. So this is something unrealistic. On performance or non-performance, if you're making a promissory note, it is not valid. It is not a promissory note. It's just a note which is not going to consider under the negotiable instrument. Happening or non-happening of the event. As I told you that you cannot give an instrument that I'll pay you 10,000 if the rain does not stop in our city. Right? So that is not a promissory note. It cannot be considered as the promissory note. However, the promise to pay may be subject to a condition. Promise to pay must be subject to a condition, as the condition was 2 months after date. After 2 months, we'll be going to pay the amount, which according to the ordinary experience of mankind is bound to happen. It is that you cannot pay the amount together right now. If you buy a phone for 1 lakh rupees, so you cannot pay the entire amount right now. You're bound to pay in some time. So if the things are normal and in the ordinary course of business, then they can be considered and these conditions can be considered. Okay. We'll see some examples that will help us. I promise to pay B 507 days after my marriage with C. The promissory note is invalid as marriage with C may happen or may not, right? You cannot give this condition that if I marry C, then only I'll give you 500. So that is not right. Marriage is an uncertain event. It can happen or maybe the situations go bad and it cannot happen also. So this is not a promissory note. It is invalid. I promise to pay B 500 on D's death. As death of D is certain, promise is unconditional. Thus, promissory note is valid because death is going to happen one day. It is certain. If it is not going to happen on 15th of February, it may happen on 26th of February, or it may happen 5-10 years back, but it is certain that someone is going to die. So then you're going to make the payment. That is okay. I promise to pay B 500 rupees on D's death provided D leaves me enough to pay the sum. Invalid promissory note, as promise is dependent on D's leaving behind the money. Now here what they have done, they have given a certain condition happening of an event. See, now I promise to pay B. So R is promising to pay B. If D is going to leave 500 rupees in the bank account for R. But this is dependent if when R dies, if he is going to give the 500 rupees. Now I'll give you a basic example. We see that our grandparents or our elders have a will, right? They have a will prepared, or we might have heard this word in the movies, etc. That as per the will of this person, he is getting 500 crores of rupees, or all the property that is there, this bungalow that is there, belongs to the person because of their will. Now, what they have said here, if D's death happens and D writes in his will to pay Mr. R 500 rupees, he is going to give 500 rupees in the name of R, then only R is going to give to B. That is again a condition involved. We don't want any condition. If you are making it on the happening of an event or any condition, then it is not a promissory note, right? So this is also an invalid promissory note. A promissory note must be signed by the maker. It must be signed by the maker. Otherwise, it is incomplete and ineffective. Otherwise, what it becomes? Incomplete and ineffective. Okay. Promise to pay money only. You cannot pay in any other terms. No jewelry, nothing. Only money. I promise to pay 500 to B and to deliver him my black horse on 1st January next. It is not a valid promissory note, as the promisor needs to deliver its black horse, which is not money. You cannot give any goods or services other than the money. Then it is not a promissory note. It is not a valid promissory note. Promise to pay a certain sum. You have to mention the amount. You can't say that I'll pay him the money. What money? How much money? You have to mention now. I promise to pay B 500 and all other sums which shall be due to him. Promissory note invalid, as the amount payable is not certain. 500 you are going to pay. All other sum, how much is the sum pending? You need to know. If it is again 1000. So you need to mention it there. Okay, I'll pay 500 and 1000. But sometimes the language of a promissory note is such that the amount payable can be easily ascertained. In such cases, promissory note will be valid. Now, what is the language given when it comes to payment of interest? 500 along with simple interest at the rate of 12% per annum. Now, here we can calculate over here how much is 500 into 12% per annum, right? We can calculate the amount. So this is a certain thing. That will be 60 rupees. So 500 plus 60 rupees. That is equal to 560 is going to be paid. Now here there is a certain amount. The words of the promissory note are clear and easily ascertainable. I can easily make 12% out of 500, like of 500 rupees. That is 60 rupees. So this is very much clear. Okay. I hope we are clear with promissory note. Right? I hope we are clear till here, the promissory note and how negotiable instruments work, introduction of negotiable instrument, types of negotiable. There are three types: bill of exchange, promissory note, and checks. These are the major three types. The other ones are treasury bill, bill of lading, and the other ones, as mentioned by them, are delivery orders, bearer debentures, railway receipts. All these are also included under the negotiable instruments if they do not have another law, or if in the everyday customs, if everyday trade and commerce, these are considered to be included in the negotiable instruments. Okay. If they have a separate law, that is going to be taken under separate laws. I hope we are clear till here. Like all things are clear to you. The maker and payee must be certain and definite persons, right? A promissory note cannot be made payable to the bearer That means a promissory note cannot be made payable to a bearer person. It has to be a definite and a certain person. Section 31 of the Bank of India Act 1934 RBI Act says that only the Reserve Bank or the central government can make or issue a promissory note payable to bearer. Only they are the people who can make the promissory note payable to a bearer. Other than them, no one can make the promissory note payable to bearer. We have seen that anyone who is holding it, this is not possible in promissory note. In if you want, it should be in having a definite name or definite person should be there. No bearers are allowed in promissory note. We can see that in bill of exchange and check, but not in promissory note. Okay. Stamping. A promissory note must be properly stamped in accordance with the provisions of the Indian Stamp Act, and such stamp must be duly cancelled by maker's signature or initials on such stamp or otherwise. What they have said, this should be signed and stamped also. We saw that it should be signed. So along with this, a promissory note must be properly stamped also. Okay. And as per the Indian Stamp Act, whatever provisions are there, in that manner, it should be stamped. Such stamp may be duly cancelled by maker's signature. If this promissory note is to be cancelled, it should be cancelled by using maker's signature or initials on such stamp or otherwise. So we saw over here that there was a stamp required in this promissory note. We saw the stamp, right? We saw this word. If this is to be cancelled over here, we have to cancel it by signing over here. Okay. Whatever the signature is there of that person is to be done over here. I hope all the essential characteristics of stamp are clear to you people. All the essential characteristics of promissory note are clear to you people. Right? Let's go ahead and see the next one, which is bill of exchange. A bill of exchange is an instrument in which, in writing, containing an unconditional order. There should be unconditional order, right? And signed by maker. It should be signed by the maker of the instrument, directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of instrument. Here, bearer is allowed. You can see that in bill of exchange, bearer is allowed. Bill of exchange is an instrument in writing containing an unconditional order signed by the maker, directing a certain person, it has to pay to a certain person a sum of amount only to whom it is to be paid, to that person or to the order of that person or to a certain person or to the bearer of instrument. Let's just see. Suppose we'll see that R is the maker. Okay. Consider R as the maker. Now, this person is going to pay the sum to B. Right. B directs or B gives the order. Now, only two. So, only two is B. B to the order of B, or B gives the order to pay to C. Right. C endorses the bill of exchange to a certain person, which is E. Right. B has given it to C, ordered to C, then C has endorsed it to E, that is a certain person, or to the bearer. E hands over the check to F, right? He has not provided any instruction to anyone, but he endorses further and he has given it to F. So F is holding the bill of exchange now. So F is the person who is liable to get the amount. Okay. On the behind, on the backside of this bill of exchange, it will be written by B that I have endorsed it to C. C has written that I have endorsed it to E. E has written as I have endorsed to F. Now, what F will do is, F is going to come on the date of payment. When the due date is there of bill of exchange, F will come to R and will ask for the money. Okay. And R will see that these endorsements are done. B has sent to C, C has sent to E, has given to F, whosoever is the bearer. Now, F is the person who is going to get the money. So, as we saw that bill of exchange is an instrument which is in writing and it contains unconditional order signed by the maker directing a certain person to pay certain sum. So, few words which we need to recall again is unconditional order signed by the maker, then your certain person, there should be a certain person mentioned over here and need to pay a certain sum of money, the money should be definite. How much money is to pay? 10,000, 20,000, that should be definite, right? Only to or to the order of a certain person or to bearer of an instrument. Only to one person, as I explained to you earlier, to B, or to order of B, that is to person C, or of a certain person, order of C, that you have to pay to E, or F, who has just got this bill of exchange by someone, that is the bearer of the instrument. That is how this bill of exchange works. They've given a specimen of bill of exchange. We'll just go through it. He is the drawer. Mr. A is the drawer over here. Address of the drawer is given and date of drawing the bill of exchange is given. So we need to keep in mind all these things should be there. All these elements should be there. Then we have amount mentioned on the left hand side. Then 4 months after date. So duration is mentioned over here. 4 months after date. After 4 months of this date. April 10th. Then 4 months after this date. Pay to Mr. B a sum of rupees 10,000. Pay to Mr. B a sum of rupees for value received, for the money that has been, for the value of goods that has been received or services that has been received. A is going to pay the amount to B. Now, to Mr. C, drawee, and the address of Mr. C is given. Signature is important, as I told you, signed by the maker. A is the drawer, so A has to sign the document also. Okay, it is to be paid to B. Now, this amount is going to be paid to B, and this instrument is issued to Mr. C, drawee. So, you see, there are three people involved over here. There are three parties. Let's see who are these parties over here. Now, parties to bill of exchange, which is drawer, the maker of the bill of exchange. Drawee, person directed by drawer to pay is called as the drawee. The person directed by drawer. He is the person on whom bill is drawn. As in the previous example, A was going to give the bill to C. But C has instructed that you have to pay the amount to B, not me. C has instructed that you have to pay the amount to B. On acceptance of the bill, he is called an acceptor and is liable for the payment of the bill. His liability is primary and unconditional. If C is accepting the bill, he has been issued a bill and C is accepting, okay, I'll pay this amount. Now he is going to pay to B. A is the drawer. He has said to C that you need to pay the amount. Now, C has accepted. C has also signed the bill of exchange and he accepts the bill of exchange. But in it was instructed that C has to pay the money to B. Okay. He is the payee, the person whose name is intended in the instrument, to whom or to by whose order the money is by the instrument directly to be paid, directed to be paid. Now, as I explained you with the example, that A is the person who is drawing the bill. A had to receive 10,000 rupees from C. What he did, A issued a bill of exchange in the name of C and instructed that A had to pay the money to B. So instead of A paying to B, C was directed that you have to pay to B. I am not going to pay to B. A is not going to pay to B. C will pay to B on behalf of A. Okay. I hope parties of bill of exchange are clear to you people. A had to receive money. Okay, once again I'll explain you. A had to receive money from C and A had to pay the money to B. Okay. Now, what happened here? They said that instead of receiving the money to A and then paying back to B, suppose we'll take it was 10K over here and 10K only. Now, what he did, he had to receive something from C and give it back to B. Now, what he did, don't give me money, asked C not to give money, directly pay amount to B. You have to, C has to directly pay the amount to B. Okay. That is how he drew a bill of exchange. He drew a bill of exchange in the name of C and asking to pay the amount to B, directed or ordered to pay the amount to B. Okay. I hope now this is clear. The parties are clear. So, A is the drawer, C is the drawee, and B is the payee, the person who is going to receive the money in his name. The order is made and is directed to be paid. Okay. I hope the definitions are clear. Let's see what are essential characteristics of bill of exchange. Now, it must be in writing. We saw that. We saw a specimen also, how it should be in writing. So, it is compulsory to be in writing. Must contain an express order to pay. It contains an order to pay. Just look at over here. We have an order to pay an amount. The order to pay must be definite and unconditional. The amount is definite, person is definite, there is no condition given. 4 months after it. So that is what is the thing. That is what is the condition. The time period is given. That is not a specific condition. Drawer must sign the instrument. We saw signature of A. Drawee, drawer, and payee must be certain. There should be some person. You can't say that paid to someone who is having 5.5 feet of height. That is not certain. Where are you going to find that person? It is specific that you have to pay it to this person. The name of the person should be mentioned. All these three parties may not necessarily be different person. It can happen that the drawee and the drawer and the payee may be same. See, A might have instructed that pay the amount to me only. So he is the one who is going to get the amount. He is the one who is going to be the payee, and he is the only one who is making it, right? Instead, A was going to receive money from C. But A did not have to pay anyone. So what he is going to do? He is only the drawer and he is only the payee, and C remaining the drawee. Okay. Now, drawer, drawee, and payee must be certain. All these three parties may not necessarily be different persons. One can play the role of two, as I explained you earlier. But there must be two distinct persons in any case. There should be one drawer and one drawee. Payee can be the drawer also, but it is important that drawer and drawee should be separate. As per Section 31 of RBI Act, a bill of exchange cannot be made payable to bearer on demand. A bill of exchange, if you go to the bank, it will not be made payable to bearer. There should be some name. If you make a bill of exchange, there is no name. The person who is having it cannot get the money on demand. Okay, there should be specific name. Let's see further what else is given. Yes, that's it. They have given about the essential characteristics. Let's go ahead. Examples and some more characteristics they have given. On demand, pay to the bearer the sum of rupees 5,000 for value received. If it is written on demand, pay to the bearer. If the drawer, if the maker of the bill of exchange says that pay this amount to the bearer person, whosoever is having this bill of exchange, that will be wrong. It is invalid bill of exchange. We have learned that there should be a certain person. A bill of exchange payable on demand, a bill of in which name of the payee is mentioned and is valid. Okay. So, a bill of exchange payable on demand in which payee is mentioned is valid. If the payee is not mentioned, it is set pay to the bearer, then it becomes invalid. Again, they have given an example. On demand, pay to A. When A comes and asks you for money, bank, please pay to A or order the sum of rupees 5,000. If A has given an order to pay to B, so you have to pay it to B because that is by order. But the name should be there. If there is no name or no order is given for any person, then that is not valid. Okay? It becomes a valid BOI. Sum must be certain, 10,000, 5,000, as much amount is to be paid, that should be remain certain and that should be mentioned. Order must be to pay money only. Other than money, nothing can be used in bill of exchange. You cannot pay anything in bill of exchange other than money. It must be stamped. We have seen that stamp is very much important over here. It must always be stamped. Okay. I hope the essential characteristics of bill of exchange are clear. The parties of a bill of exchange are clear. Let's see how the process works. How a bill of exchange gets encashed and who pays the money, where the money is paid and what things are there. Okay. Now, Mr. Sam. So, Mr. Sam is the drawer of bill of exchange. Okay, Mr. Sam has prepared the bill of exchange. He is the person first party. Now, sold goods to Mrs. Rita, drawee, and draws a bill of exchange. He sold the goods to Mrs. Rita. S has sold the goods to R. S is the person who is making the bill and asking for the money from R. Okay. Now, the BOE is delivered to Rita and is accepted by her unconditionally. Okay, Rita, what she does, she accepts the bill of exchange, and now this is bill of exchange. Okay, BOE. This one is accepted by her. On maturity, drawer presents to the drawee, presents the instrument to drawee for payment. Now what he'll do, he'll go and say to R, this is bill of exchange. Today is the date of payment. Give me the money. Now what will happen? R will receive the bill of exchange and pay the money to S. Rita will pay the money to Sam. Okay. And this is how a transaction completes. First, drawer makes the bill, gives it to drawee and asks them for the payment for a specific period of time, gives them a specific period of time for payment. Now, what happens? This drawee has to accept it. It is compulsory to accept the bill of exchange. So, the drawee accepts the bill of exchange and makes the payment without putting any conditions. Okay, accepts it, and on the maturity date, the drawer goes to the person and gives the payment, asks for the payment. Drawee gives the amount and the transaction is complete. This is how the few steps or process of bill of exchange happens. Okay, I hope the process is clear to you people. Now, let's see what they have given as a discussion. In above image, firstly, the seller sold the goods to buyer. Seller has sold the goods to buyer. Let's just see our case. Sam has sold to Rita. Okay. Sam has sold to Rita, buyer, customer, and then draws a bill of exchange on their name, on him. The bill of exchange is delivered by the buyer who accepts it without any condition. On maturity of bill of exchange, the buyer will pay the amount. Now, what happened? They'll send the bill of exchange. R is going to accept and send it back. Accept and send BOE to S. Now, S on the date of maturity, what will happen? They will go on the date of maturity. They will go with bill of exchange to R and ask for money, the amount. Okay. And what R will do? R will give the payment. Right? Amount that is due will be paid. On maturity of bill of exchange, buyer will pay the amount due to the payee. The payee may be the drawer himself or a third party, as we saw in the previous example. Okay, I hope the things are clear to you with bill of exchange, with the promissory note also. Now we'll be seeing the differences between two of them. Now, they have given the differences. They have given you a table form of differences, which can be asked as a question in your examination. So it is important that you memorize this or you try to understand it. If you remember, if you try to understand how the things work in bill of exchange and promissory note, if you remember that, you'll be easily able to write the difference of two. Okay, let's see one by one what all things are mentioned in it. Now, a promissory note, as we saw, it is an document written in, given in writing, instrument given in writing. Same point for both of them. Not being a banknote or currency. Here, specifically, they have given promissory note cannot be a banknote or currency. Okay. Next things are same, containing an unconditional undertaking signed by the maker and to pay a certain sum of money only to or order of some certain person or to the bearer of instrument. Same things are there over there. So the definition more or less is same. The only highlighting point in a promissory note will be this. Not being a bank note or currency note. Okay, this is some differentiating point between both of them. More or less the definition is same for both of these. Okay, it should be signed, it should be unconditional, and it should contain a recording. So, promissory note and bill of exchange. The definition of both of these contains more or less the same thing. The only dividing or differentiating point between both of these is that promissory note cannot be a bank note or a currency note. Rest all things are same with the bill of exchange and promissory note. Okay, the definition, if you see, it should be in writing, it should be in writing, it should be signed, and it should be done by the maker, signed by the maker. It should be having a certain sum of money. The person whom it is intended should be a certain definite person. It can be paid to person or to order or to a certain person or the bearer of instrument. Okay, both things are same in promissory note and bill of exchange. Only thing that differentiates promissory note from bill of exchange is that promissory note cannot be a bank note or a currency note. Okay, I hope the definition is clear to you people. Now, in a promissory note, there is promise to pay the money. Okay, you make a promise to pay the money. In bill of exchange, there is an order. No promise, nothing. There is an order over here. Then in promissory note, we have seen that there are only two parties. Here there is promise, here there is order. In promissory note, there are only two parties. And in bill of exchange, there are three parties. In the promissory note, there are two parties, maker and payee. The one who makes it and the one who is going to be getting the money, right? And this, we have drawer, drawee, and pay. Drawer is the person who makes the bill of exchange. Drawee is the person who is going to make the payment, and payee is the person to whom the amount is going to be paid. Okay. In this, maker is the person who promises that I will pay the money. Now, acceptance. A promissory note does not require an acceptance. Here, the major differentiating point is does not require acceptance. But in bill of exchange, it is compulsorily to be accepted. Without acceptance, the bill of exchange does not work, as it is signed by the person who is liable to pay. Because what happens here, the maker is the person who is promising to pay. But in the bill of exchange, who wants to receive the money is making the bill of exchange. So here it is important that it is accepted. But for promissory notes, person who is liable to pay, who is going to pay the money, from whose pocket the money is going to be paid, is promising already, is making the promise that I am going to pay this amount to you. Okay. Let's go ahead. Let's see what they've said. Yeah. Payable to bearer. A promissory note cannot be made payable to bearer. Cannot be made payable to bearer. But bill of exchange can be made payable to bearer, but not on demand. Okay. This is a differentiating point over here. Promissory note cannot be made payable to a bearer. A promissory note cannot be made payable to bearer. But in this hand, a bill of exchange can be drawn payable to bearer. You can draw it payable to bearer, but not on demand. You cannot go to the bank and ask that I am the bearer of this bill of exchange, give me the money. Okay. It can be drawn payable to bearer, but it cannot be payable to bearer on demand. If they go before the due date and go to the bank and ask for money, bank is not responsible for paying the money, because on demand these things don't happen. Okay, I hope the differences are clear between promissory note and bill of exchange. So we'll move forward and see our third type of bill of exchange, that is check. Section 6 of the Negotiable Instrument Act gives us the definition of check and all those things required for understanding the check. Okay, now a check is a bill of exchange drawn to a specified banker, drawn on a specified banker, and not expressed to be payable otherwise than on demand, and it includes the electronic image of a truncated check, and check is in the electronic form. Now these things have you can see that can be in a digital form, or a check can be in a physical form also. Okay, now what they've said, this is drawn on a specified banker. If you have a check of suppose XYZ bank, this bank is going to pay the amount if you draw a check on any person and give the check of your bank. Suppose I have an account with SBI, State Bank of India. Let's take an example. And if I give a check of State Bank of India to Mr. X, okay, so Mr. X will, what he'll do, he will go and give the amount, give the check in the bank, in his bank, whatsoever bank it is. What their bank will do, their bank will go and talk to SBI of my bank. Okay, SBI branch of my bank, wherever I have my account with that branch, they'll go and talk to SBI and they'll ask them to give the money, debit my account, reduce the amount balance in my account and give the money to them, so that they will be able to pay the amount to Mr. X. Now this all process takes lot much of time, but this process is a specified process given for a check. I'll just be showing you a check. Give me 1 second. How a check looks, right? You might have seen earlier, or you might have heard about it that check is given for giving some payment. So this check is issued by John Smith. Now, I hope this is not from us. Let's just take this SBI check. Okay. Now, if you can just see this. Yes, now it's visible to us. State Bank of India. The name of the bank is given over here. And they are the one who are issuing the check. Here, date is given, month is given, year is given, on which date you are signing the check. Then pay the amount. Suppose they are going to pay this amount to Mr. X. So, they'll be mentioning over here Mr. X name. Rupees, the amount if they want to pay rupees 10,000. So, they'll be mentioning over here 10,000 rupees. In words, 10,000 rupees. Then in this column, they'll have to mention the figure, they'll have to mention the amount in numbers. Okay. Account number is to be given. Here it comes printed for the checkbook. I'll be showing you the picture of a checkbook, also the original checkbook, and valid for rupees this much. So how much amount maximum they can pay is mentioned over here. They have given that they have to sign over here. Check is to be signed. This is a specific check number. It is different for all the banks. Okay. So this is a check number given. This is the series number that they have given. I hope check how does it look in actual life is clear to you people. Now coming back to our notes. Let me stop sharing and unblur the background. So this is how a check looks. Okay. This is on your screen. If it's visible to you people, this is how a check looks in actual life. This is a blank check that I want to show you people. Here the account number is already given. Here name of the account holder is given. Okay. I'll attach a picture also for you people. I just wanted you people to know how it looks in actual life. I hope the check thing is clear to you people. And you can also ask your parents, etc. to show you their checkbook so that you get a real life experience kind of thing. I always try that I can inbuilt or I can inculcate some real life things for you people. Okay, let's join back to our notes. Yeah, so we were discussing check and let's see what they have given. Now, check is a bill of exchange drawn on a specified banker and not expressed to be payable otherwise than on demand, and it includes the electronic image of a truncated check. So what we saw is an electronic image of a truncated check and check in the electronic form. There can be checks in the electronic forms also. Okay, now check is more or less a bill of exchange drawn on specified banker payable on demand. Whenever the check is given within 3 months time period, this is to be given to the bank and they can encash their money. Payable on demand means what? We have heard this payable on demand, payable to bearer on demand is not possible in bill of exchange. But what exactly is payable on demand? It should be payable whenever the holder chooses to present it. What they have said here, whenever the holder has chosen or have selected a date to present it, whenever the holder chooses to present it to drawee the banker. The expression banker includes any person acting as a banker, any post office saving bank also. Suppose as I showed you the example of IndusInd Bank, which was my checkbook, and I gave you the live example of SBI also on the screen. So in this example of SBI where we saw that this thing is there, the check is there. Now if this SBI check I am issuing, I am the person who is issuing the check in the name of Mr. X. So Mr. X, what he is going to do, he is going to go to the bank. The bank is the drawee, they are the person who is going to give the money. Okay. Now, any person can be acting as a banker, whichever bank he belongs to. Suppose he goes to Kotak Bank, he has his account in Kotak Bank. He'll go to Kotak Bank, or he has a post office saving account. He'll go to that saving account, give this check to them and ask them, I need the money, debit Miss Rushali's account and ask her to pay the money. Right? So what Mr. X does, he goes with the check to the bank, Kotak Bank. Kotak Bank gives an instruction to SBI Bank, wherever I have a branch. They are going to instruct it and tell them to debit my account, send that money to the account of Mr. X. Okay, this is how this internally works. I hope the process is clear. I am just trying to give you all the things that are possible. Okay. Now, explanation 1 that they have given for this section, check in electronic form means a check drawn in electronic form by using any computer resource and signed in a secure system with a DSC, digital signature, and a symmetric crypto system or electronic signature as the case may be. Okay, this is one in electronic form. I'll also show you an example of this. Give me 1 second. An e-check looks, we'll be seeing a lot many of example. This is how an e-check works and a payment processing happens. You fill in the details and this is where it comes in the form of a check. Okay, or you can see one more image. This is a e-check generated. Now here your account number detail is there, your routing number is there, what all things are there, payment amount is given, then you have your date mentioned over here, account number is given. So this is how an e-check looks like, electronic check looks like. Okay, this is an example. Then this one is an example where electronic check functions. Okay, here see, pay to the order of this much, this person, what amount is to be paid, it is mentioned over here, and the routing number, the account number, all these details are given. Routing number is not there in India, so we don't have that thing over here, but account number is something which we have. So this is how an electronic check looks like. Okay, I hope we are clear. Now, coming back to for the purpose of this section, the expression asymmetric crypto system, computer resource, digital signature, electronic form, and electronic signature shall have same meanings respectively assigned in the IT Act. DSC is something that is a specified token given for a person, and they have that DSC, and with that only they can sign. That's a digital signature. It contains a password to unlock it. That is your digital signature. Electronic form, as we saw, asymmetric crypto system, they may give a crypto number to them, and that is what it is. That is how it works. And crypto computer resource, this can be a physical print of it that can be seen in front of your computer screen. Okay, electronic signature, as I told you, that is a specific password thing. Same meaning that is there in IT Act can be used here. Yes. A truncated check means a check which is truncated during a clearing cycle. What we saw on the SBI thing, or the one which I showed you with my personal check. So that is also a truncated check. It goes into a process, truncation process, either by the clearing house during a clearing cycle, either by a clearing house or by the bank, whether paying or receiving payment immediately on generation of an electronic image or for transmission, substituting the further physical movement of the check in writing. Now, what do you think, how many days it will take? Now, suppose if I give a check in the bank of Pondicherry, let's take an example. I give a check in the bank of Kotak Bank, Pondicherry. Now, I am sitting in Maharashtra. Okay, I'm sitting in Maharashtra. My bank is in Maharashtra. I have sent the payment. I've given a check to Mr. X in Pondicherry. So Pondicherry, he is having the check. He is going to go to Kotak Pondicherry and give them the check. Now Kotak Pondicherry, what will do? They have to process the money by the day end, or by tomorrow morning they'll process the money. But this check, which is in the physical form, has to reach to Maharashtra, right? Has to reach to Maharashtra. I live in Aurangabad. So it has to reach to Aurangabad or Chhatrapati Sambhaji Nagar, which is now it has been changed. So it has to reach there. Now, this process is going to take 2 to 3 days of time. But the person who has issued, who has been given the check, Mr. X, is not ready to wait. He says, I want the money within 2 days. what they'll do is they'll immediately process the payment. Looking at the image, they will be sending the image, scan image of the check which is given by Mr. X. Kotak Bank will send an image of the scanned check which has been given by Mr. X. This scanned image is going to be sent to Bank of SBI Bank, which is there in Aurangabad, Maharashtra. Okay. Now this is going to be used over here. This is how the things work. The process of a truncated check works. That's a physical copy. It is going to take 2 to 3 days. We don't know how much time it is going to take, but it may take a lot much of time due to any weather conditions or due to strikes, etc. There can be a delay, but we can't delay the payment now. So for this, what they do is they process the payment, getting the confirmation from the other bank. They see that okay, this account belongs to Rushali Demra. They are going to process the amount after seeing that the balance is there in my bank. They cannot process it unless there is balance. If I issue a check of 10,000, I need to keep in my bank account 10,000 on the date of payment. If Mr. X says, I am going to go for presentment on 25 February. Okay, let's just consider. So on 25th February, when he goes with the check to the bank for presentment, I should have in my account this much amount, 10,000 rupees of amount. Okay. Explanation 2, let's see what they've given. For the purpose of this section, the expression clearing house means clearing house managed by the Reserve Bank of India or a clearing house recognized as such as RBI. So all these checks are cleared by the banks through RBI. RBI is our clearing house. For the purpose of this section, again, asymmetric crypto, computers, resource, digital signature, electronic form, same meaning as it is given in the IT Act. A combined reading of section 5 and 6 tells us that bill of exchange is a negotiable instrument in writing containing an instruction to a third party to pay a stated sum of money at a designated future date. What is there? Designated future date. Here date is specified or on demand. Whereas a check is also a bill of exchange, but it is drawn on a banker and payable on demand. Check can be asked for payable on demand, like there is no bearer check can be asked on payable of demand, but it is issued on a banker. It is not issued on any person. I cannot draw a check on Mr. X. I have to draw the check, or it has to be presented to the bank only. I have to use bank as a media. Okay, I cannot design my own check, Bank of Rushali Demda, so the specific check, that won't work. You have to draw the check on a banker. Okay, State Bank of India, Kotak Bank of India, HDFC Bank of India, any other nationalized or cooperative bank or any post office saving bank also, we can issue a check. Let's see a specimen. We have already seen an example. Let's just go through the specimen of the check. Now, what they have said, date is to be mentioned. As we saw, the banking name is there. Then date is to be mentioned. Pay the amount, sum of rupees, how much in words. Account number is there. Then here, they should have mentioned a box to give the amount also. Right? Then ABC Bank, name of the bank, etc. is given. Check number is given. These are all further details for the check that are given on the check present already. Signature is to be done over here. Okay. This is how the system of a check works. Here there are two parties involved. Drawer, person who draws a check, that is makes the check debtor. His liability is primary and conditional. They have to pay them. The specific bank on whom check is drawn makes the payment on the check. In case of check, drawee is always banker. Drawee is always banker. Okay. Drawer, one who makes the check, and drawee is always bank. Drawee in case of need. When in the bill or in any endorsement thereon, the name of person is given in addition to the drawee to be restored to in any case of need, such person is called drawee in case of need. If they have said that, if I say to Mr. X, okay, Mr. X, if State Bank of India does not give you the amount, if they do not pay you the money, you can come to me and I am the drawee in case of need. If you need any help, if State Bank of India is not giving you the payment by any source of reason or any way, then you have to come back to me. I am the drawee in case of need. Person who is going to restore the payment, who is going to restore the title of drawee. Okay. I hope this is clear. Then we have the third party, which is payee. Now, person named in the instrument. If I'm drawing a check in name of Mr. X, so X is the payee. X is the person who is going to get the money. Same way as in bill of exchange. That is the person in whose favor check is issued. To whom or to whose order the money is by instrument directed to be paid is called the payee. Payee may be the drawer himself or a third party. Okay. Then check summarized form. Person who is a maker is the drawer. Person who is directed to pay. We direct the banks to pay. Check, it is only on the basis of banks. So bank is the drawee. Person in whose favor it is issued is the pay. Person in whose favor it is issued is the pay. According to the definition of check under section 6, a check is a species, a special species of bill of exchange. It is a type of bill of exchange. We have heard this word species when it comes to cat species, dog species. So it is a species of bill of exchange. Then it should fulfill what? All the essential characteristics of bill of exchange. Same essential characteristics of bill of exchange. Must be drawn on a specific banker. A specific bank should be there. You can only issue on one bank. It must be payable on demand. Whenever the person wants to receive the payment, whenever Mr. X wants to receive this payment, it should be payable. That is the compulsory thing. These two additional features distinguish a check from the bill. Now, whenever it is to be payable, because in bill of exchange, what happens 4 months after it. So, if the person goes for endorsement before it, that is a different case. But on demand, the person won't get the money in the bill of exchange. But in the case of check, what happens is whenever the bill is issued, if I issue the bill, suppose on 1st of February, okay, 1st of February 24. Now, if within 3 months, Mr. X has to present it to bank. Okay. Now, it should be drawn on a specific banker. This is a separate, different essential characteristic of a check. I hope the essential characteristics of check are also clear to you people. Now we have seen all the three types of all the three types of negotiable instruments. Now let's see classification of negotiable instruments, which we have not seen earlier. Bearer instrument, order instrument, these things, inland instrument and foreign instrument. Section 11, 12 and 13 talks about this.